Hi, I'm Richard Rosso, Director of Financial Planning at RIA Advisors with my 2019 top financial tips for financial fitness. Number one is become better acquainted with your portfolio allocation. Odds are you've become complacent to adjust your portfolio allocation of stocks, bonds, and cash. So after a major market routing that we had last year, hopefully you're paying attention now. We believe stocks are going to provide lower returns along with greater volatility for the foreseeable future. In that case, you must make sure your current allocation aligns with your financial goals. Number two, what's your game plan when it comes to taxes? January is an opportune time to meet with your tax professional and map out a tax plan for the new year, especially in the light of the Tax Cuts and Jobs Act. So take advantage of tax credits like the child tax credit, which is now refundable. That means even if you don't owe taxes, the credit makes you eligible to receive a percentage of the credit paid to you in the form of a refund. How's that? So the credit now applies to many more parents. Taxpayers who are married filing jointly with an adjusted gross income of $400,000 or less can receive the full credit. Phase-outs for this credit will start at these income levels. Remember, the child tax credit, well, it's a credit, not a deduction. Because it's a credit, it directly reduces the amount you owe the IRS. So, for example, your tax liability is $3,000. But if you're eligible for $800 of child tax credit, you only owe $2,200. So check in with your tax pro to determine other credits you may be eligible for to receive this year. Also, don't forget to check your tax withholding since new tax brackets apply to income earned this year. Withhold too little and penalties may apply. You withhold too much and you give the government an interest-free loan you will not get back until next year in the form of a refund. Need help? Contact your tax advisor or check out Notice 1036 from the IRS, which provides instructions. Next is consider a Roth over a traditional IRA or 401k. You know, the financial industry teaches savers and investors to sock as much money away into tax-deferred accounts as possible, such as traditional IRAs and 401ks. You know, the advice is designed to help you minimize taxes, and the lie is you're going to pay less taxes in retirement. Wrong. What you want in retirement is diversification of accounts where taxes can be better controlled. So Roths are funded with after-tax money and may be withdrawn at retirement 100% tax-free. So at retirement, strive to have half your investments in traditional 401k, half in Roth. Contribution limits for 401k, including Roth, 403bs, most plans and the federal government's thrift savings plans will increase from $18,500. They are now $19,000 in 2019. There's also what we call a catch-up contribution limit for employees age 50 and older, and that remains unchanged at $6,000. Last is to tackle your money insecurity. Listen, we all have a money fear. Fear of outliving our nest egg, fear of a lingering illness, fear of needing long-term care as seniors. So make 2019 your year to address that money insecurity. Often you can set a long-term goal to battle it. Set aside $50, $100 a month. Consider working with a certified financial planner to create a comprehensive plan along with an action plan to hit your goals and battle that insecurity in 2019. You need help? Reach out to us at riaadvisors.com. I'm Richard Rosso. Thanks for watching.